So in exercise 1721B, we're dealing with the issue of the fair value option. What the issue is in the case of the fair value option is that the FASB gives companies the option, it's not a requirement, it's an option, electable at their choice, to report on their balance sheet financial instruments at fair market value rather than at cost or amortized cost or some other amount. Again, firms can elect to report financial instruments on their balance sheet at fair market value and run the unrealized gains or losses resulting from the change in those financial instruments through net income. This option is applied on an instrument by instrument basis. So what does this all mean? What's a financial instrument? A financial instrument includes things that we've been talking about like stocks and bonds, but it includes other types of assets as well as other types of liabilities. For example, a bond payable that the company has, where the company's actually issued bonds to other investors, and they have a liability sitting on the balance sheet. As you know from earlier in Intermediate 2, the company's going to report that liability on their balance sheet at amortized cost. If a company uses the fair value option that's available to them, they can choose to report that bond on their balance sheet at fair market value. So fair value option, companies can choose to report financial instruments on their balance sheet at fair market value and run the unrealized gains and losses that arise from changes in the value of those financial instruments through net income. The option is applied on an instrument by instrument basis. So for example, if the company has 2 bond issuances outstanding, they can choose to report one of those bond issuances at fair market value and the other bond issuance at amortized cost. Or if the company has 2 stocks, they could choose to report one of the stocks at fair market value and the other stock under the normal available for sale or trading security type rules. Okay, so here we are in 21B. Basic facts are we've got 3 securities. We've got a held-to-maturity debt security, an investment in Olive Company stock, and we have a liability on our balance sheet, bonds payable. The first 2 are assets of our company, the debt security investment, the common stock investment. The bond payable is a liability on our balance sheet. We're given information on the book value or cost of each of those 3 items as well as the fair market value of those items at December 31st, 2014. Now, down here in the facts, we're told that the company elects to use the fair value option wherever possible, and that right now, before it prepares any sort of adjusting journal entries, the company's net income is $360,000. So, with all of these facts, what are we supposed to do? Well, if you look at the 2 securities that we have plus the bond payable, each of these represents a separate financial instrument. The investment in the debt security, the asset, is depreciated. The investment in the company's Olive Company stock is appreciated. Fair market value is greater than cost. And then the fair value of the liability, the bond, $490,000, is less than the amount that's currently shown on the company's balance sheet. If we use the fair value option, then what we're going to do is we're going to prepare an adjusting journal entry that takes the balance in each of those accounts from its current balance reflected in the cost column to equal what the fair market value is. In other words, we're just going to adjust the account balance to equal fair market value. So in the case of the investment in debt security account, right now it's got a balance of $60,000. We need to reduce the balance from $60,000 to $59,000, and the way we're going to do that is to prepare an adjusting journal entry that credits the investment in debt security account for the excess of cost over market value. of $1,000. In the case of the investment in Olive Company stock, we need to move the carrying balance of that investment from $400,000 to $430,000, which is the fair market value. And the way we do that is to debit the investment in Olive Company stock, an asset account, by $30,000. And finally, with respect to the bond payable, right now we've got a liability called bond payable sitting on our balance sheet at $500,000. We need to reduce that liability from $500,000 down to $490,000, and of course the way we're going to do that is to debit the liability account, debit the bond payable account for $10,000, which is the difference between cost and market value. And we need a residual, in this case a residual credit, representing the net of the three adjustments that we just made here, in order to move these financial instruments to their market value. The net change in value of these financial instruments is a $39,000 gain. So we're going to credit this unrealized holding gain or loss account for $39,000. This account is a component of income. It's not a component of equity like in the case of available for sale securities. We're taking directly to net income the change in the value of these financial instruments. So as a result of this adjusting journal entry, which is used to apply the fair value option, we take our net income from $360,000 before the adjustment to $399,000.